Michael Burry, who becomes a household name after his winning bats against the mortgage crisis, was featured in the film The Big Short. Since then, his fame has skyrocketed to a level unseen before. From locking horns with the biggest forces to being a guiding light to the novice investors, today he's reigning the Wall Street heart with a multi-million-dollar portfolio. The 2008 financial crisis was one of the worst economic disasters ever. The economy went into recession. It caused the biggest recessions since the Great Depressions of 1930s. In the early 2000s, Michael Burry had realized that many subprime home loans were in danger of defaulting, and he had started betting against the housing market. Burry's actions attracted the attentions of a few more bankers and other opportunists. In today's video, we tell you how Michael Burry predicted the 2008 housing bubble. But before we start, subscribe to our channel and hit the bell icon to never miss a video from us. Now, let's begin. Michael Burry's activities assigned capital, and he thought of himself as a value investor. Soon his attention was caught by the growing importance of the housing sector. The amount and type of leverage, the generation's old acceptance and societal assumptions that the prices always went up, and the very broad societal participation was greater than 60% in owning homes. All this called out to him. This was not just a case where a few early adopters made a lot of money or a few venture capitalists had acted badly. The entire economy depended on home price appreciations, the slope, home price appreciations, consumer spending, jobs, securities markets, all of it. He could see financial Armageddon as housing with the main trigger point. In predicting when and how the collapse would occur, Burry's main focus was again on the actions of the government and the response of the private sector. All this was much in keeping with his studies earlier in Chicago. The whole idea of an American dream being related to owning a home has been around for nearly a century, and nearly every modern president has promoted it in one way or another with a name program. Burry said, the government has helped return the GIs after World War II by providing homes, and the government was the first to securitize mortgages in the early 70s. Privately securitized mortgages followed shortly thereafter, thanks to Guarnieri. President Reagan would sign the Secondary Mortgage Market Enhancement Act, which among other things allowed insurance companies and pensions to invest in these securitized mortgages. Also, a short time later, Reagan signed a law that had made these types of products much more tax efficient. To be more clear, the securitizations of mortgages means that there is actually virtually no limit on the number of mortgages that can be originated by an institution. They just get sold through Wall Street to investors, Burry said. All this was considered harmless, and it was a good thing for the American dream to almost all concerns for decades. But the desire to satisfy these dreams needed a tool, something that would make home loans themselves much more affordable for those without income credit or assets to afford one. Back in 1982 again, the depository institutions legalized adjustable rate mortgages for the very first time. These adjustable rate mortgages would in various forms be the primary mortgage product at the heart of the collapse of our economy 2.5 decades later. But the adjustable mortgages did not take off immediately. They really did not take off until more additional regulatory and legislative changes in the 1990s and early 2000s had jump-started the market for affordability products in the mortgage space. The general point was to increase the pressure on banks to make more loans to less credit-worthy customers, and dated subprime insurance bloomed about 5 to 6 times during the 90s, and there was a mini crisis thereafter. Bill Clinton had a name for this drive, and he named it as the National Home Ownership Strategy. In the year 1999, the Gramm-Leach-Bliley Act repealed the Glass-Steagall Act of 1933 and officially removed the increasingly leaky separations between the activities of the Wall Street banks and the depository banks. All these freed banks to experiment and to expand into new lines of business, none more faithful than the experiment with derivatives and subprime asset-backed securities. The private market therefore gained the capability to mount a massive response to the all-government's effort to stimulate housing. During the 90s, people had to deal with the stock market crash. The Federal Reserve had also stepped in, cutting the discount rate at a change at charged lenders from 6% to roughly 1% in order to stay off recessions. Other key short-term interest rates also followed from the year 2001 to 2003. The American home prices, which had largely moved in line with the household income over the decades, suddenly accelerated up and away from the household income trend line. The home prices had good reasons for such deviations from 2001 through 2003, rapidly declining the short-term rates to lows not seen since the aftermath of the Great Depressions had included a boom in adjustable rate mortgages. A homeowner's dollar went further during the teaser rate period, and so home prices rose unnaturally. The risk would be low as long as home price appreciation was strong under this paradigm. Thanks to refinancing options, it was a positive feedback loop with the full blessing of the US government. Amidst all the early fears that the housing market was getting ahead of itself in 2003, Fed Chairman Alan Greenspan had assured everyone that national bubbles and real estate simply do not happen. Burry had served and surveyed the national trends in housing At that time, he wondered whether common sense ought to rule against the applications of predecessor to the unprecedented. Mr. Greenspan went on to advise in 2004 that they were underutilizing the new types of adjustable rate mortgages, and in 2005, he allowed specifically the technologies used by subprime lenders to get subprime borrowers into homes. Tragically, for all, the Federal Reserve actually had the authority to block any lending activity it deemed deserving of such treatment, but it had absolutely no will to do so. In any event, by 2003, mortgage rates had stabilized at 40 years lows, and importantly, plain vanilla adjustable rate mortgages had already come into widespread use. This was a big problem for public lenders with a growth mandate, and they needed to stimulate more loans volume despite stable mortgage rates and inadequate income growth. At this point, if home prices were to rise significantly, they would have to float almost entirely on the back of the type and quality of mortgage credit provided to the buyer. Critically, the interest rates alone would no longer determine affordability. Burry noted for his investor that the countrywide financial, a very large national mortgage lender, had reported subprime mortgage originations up by 158% year over year, despite a 24% decline in the overall loan organizations. Evidence was therefore manifest. The banks were chasing bad credits inclusive of housing speculators. The only questions that came to his mind was how far could they go ominously far jump. In his mind, he would mark the point of maximal price in the asset, and he imagined that the top in the housing market would be marked by a mortgage in which homebuyers of subprime quality were enticed to buy with teaser rate monthly payments near to zero. He was very aware that the lenders would take this to the nth degree. Thanks to the securitizations of any loans the bank did not want to keep, they could always sell through Wall Street to investors who were simply ravenous for yield. Importantly, because subprime mortgages were being turned into securities, there were some mandatory regulatory filings, and this is how he educated himself on the sector. At times, Burry felt that he was the only one reading these things. By the summer of 2005, these documents had revealed that interest-only mortgages had taken a substantial share in the subprime market. Only a year or so later, after they were introduced to that market, more than 40% of subprime originations were passing through Wall Street on their way to the investors. This was up from 10% a year earlier. Simultaneous second lien mortgages ramped up significantly. The top would soon be fast upon us as a subprime interest. Only adjustable rate mortgages started to touch maximum sales channel penetrations. He saw the introductions of yet another more extreme teaser rate mortgage called the payment option. The arm or cash flow arm in this new type of mortgage was never seen before. In a widely standardized format, the borrower could basically pay next to nothing each month, and the unpaid interest would simply negatively amortize into the growing mortgage balance. Rampant cash-out refinancing had already made the home a magical ATM for most Americans, and now housing has its credit card. Burry had been waiting for peak credit, such as a mortgage product would only exist as long as home price appreciation was a central assumption, and home price appreciation was not long for this world. Burry knew this because by 2005, as early as in 2005, he could see these mortgages being packed into securitization. He read those two. Those are between subprime and prime. Not all of these, though, were sold not. Home prices starved of peak credit and would fall steeply as mortgage and refinancing options crumbled away. According to Burry, the crisis in his view would start in 2007, by which time teaser rate periods on the vast majority of these new types of mortgages would expire or reset. For a population of homeowners trapped in mortgages they could no longer afford or on the way down, housing would take consumer spending, jobs, everything with it. A positive feedback loop of a very damaging variety was set up. Seeing the economy on the verge of collapse, Burry did the logical thing and he sought to profit from it. That's it for today's video. Thank you for watching. If you enjoyed it, please like, share, and subscribe to our channel Michael Burry Explained to stay up to date as to how and when the famed investor is placing his bets. See you in the next video.